My name is Tosin Ibilari from Osogbo, Osun State. Thank you, sir.
Yeah, Mr. Tosin, nice to have you on the call tonight. Thank you so much. You can mute your mic, Mr. Tosin. Oh, you're welcome, ma.
Thank you. God bless.
Yes, ma. Thank you, ma. So you can kindly mute your mic, ma'am. So who else do we have on call that want to introduce him or herself?
Okay, I'm Momoriwa Ajijomoni, and I'm calling from Ekiti State.
Wow, that's beautiful. Momoriolua, you are welcome. I'm glad to have you on this call tonight. Glad to have you on this call tonight. All right, who else do you have on call that is here to introduce him or herself?
Good evening. My name is Samuel Akinyola from Osun State.
Okay, Mr. Samuel, glad to hear from you as well. You're welcome. You're welcome. Okay, so I think we can move on now. All right, so once again, glad to have every one of us on board tonight. And I believe tonight is going to be an insightful session. We are going to be looking at building your investment portfolio. And essentially, we'll be looking at how understanding the simplicity and the complexity of investment influences our investment decision and even the outcome eventually. All right. So not to waste the remaining time that we have, because this seminar is just going for an hour. So I want to ask a simple question from anyone who cares to answer, because I know that uh, we are not a novice when it comes to investment. You've been hearing of investment for a while. It's possible that you have even done one or two investments. You might even be doing one presently. So I want to ask that, okay, just in maybe two sentences, what can you say about investment? Like anyone here, like what can you say? It's not necessarily a definition. You can just give an idea, an example, anything that you can say about that. So what can you say about investment? Anybody? Anybody? Is there anyone who want to talk?
Okay, I think I have this idea. It's like buying stocks and shares, something like that, or putting money into the shares or stock of a particular company.
Yeah, thank you so much, Momo Olua. I think that's a very good response. So investment, as she said, is like example of it is like buying stocks or having a company share, putting money into it, and waiting for a brief moment to see how everything turned out to be. Yeah, that's a very very perfect idea. So that's just a type of investment. Investment basically is things that you do. It can either be what you actively do yourself, that you put your time, your effort, your energy, your money into, or probably you engage in somebody else venture. Somebody says venture, talking about stocks, talking about shares, talking about all these type of investment like cryptocurrencies and the like. So you invest in these instances now. You invest your own cash, your own hard-earned money, trusting that the tools you are investing on will bring a kind of return that is meaningful, so to say, that is juicy, attractive, so to say. And I will believe that we all know that every form of investment comes with risk. Investment comes with risk and return, RR. Without no risk, no return. So anything that does not have risk in it, there's tendency that that thing might not necessarily be a good form of investment. So if risk is not there, it might not be a very good kind of investment if everything is just looks so plain and the like. So, and there is a kind of saying that okay, the higher the risk, the higher the return, the lower the risk, the lower the return. So investments most of the time and always comes with risk. So there's a type of risk that comes with every form of investment. Now, before you dive into any kind of investment, it is important that you understand what you are investing in. It is very, very important that you understand what you're investing in. A lot of people, they will just see an advert online or see what people are doing. They're carried away with majority. Probably they're talking about something that, oh, this is what people are doing now. This is one investment. This, without understanding the rudiments, the fundamentals, how the thing really works, they will jump into it and they will sink with it. A lot of stories are around that subject, whereby people dabble into things that they don't understand and they regretted that they even ventured into it. So it is very important that you understand an instrument before you dabble into it. You understand what that thing is all about. Every investment has their scope of operation, has their definition. There's always how it works. So it is important that you get such understanding of how an investment work and an instrument work before you dive into it. Now, why is that important? Understanding an instrument will make you to understand that is this type of investment, is it for me? Is this what I can do? When you understand an investment, you get to understand the risk involved. Am I ready for this kind of risk? A lot of people, they just want something that can multiply their money. Thank God that investment comes with the opportunity to multiply funds. Even without investment, it will be hard to multiply funds. An investment is a vehicle whereby you can use your existing money to make more money. So your money is working for you. But if you don't understand, you will not know the risk involved. And not knowing the risk involved will open you up to any kind of backlash that may come as a result. So that's just a opening ground. It is important that you understand a tool, an investment tool, before you start to use it. Understanding it will make you to understand that, okay, is this thing good for me? Am I ready to do this kind of thing now? Some people have, from experience, I've seen people who invested their school fee or money that some people kept with them and they invested it in something that they don't understand. And it resulted into a lot of issues for them eventually. And there is a popular saying also that don't invest the money you can't afford to lose. Nobody wants to invest to lose, yes. But when it comes to investing, be sure that the money you have with you that you want to invest should be a type of money, a category of money that if the worst happen, you are fine. That's where the risk is factored. Anything that comes with risk is like there's two sides of it. It's either you win or you lose. So if the worst happen, you are fine. So these are the kind of capital, the kind of cash that you should invest. And as per what we do on the reports, we educate our customers to understand why you must save. When it comes to money management, personal finance, the first thing a well educated, I'm talking about financial education now, person should do as when you start to make money is that you should have a disciplined kind of lifestyle, that you have a savings. You don't hit everything. No matter what amount of money you are earning, it is important that you save, and as you are saving, the purpose of that saving is not to spend it on things that are not important. We come from different background, we have different reasons for doing things and the like. Some people, their purpose of saving is just to save a lump of cash and eventually go for a birthday party, or even throw it at their home for their own birthday party, or even spend it on expensive clothes, jewelries, and the like. I'm not saying that is bad, but if you are the type that you have a goal of building wealth, you have a goal of having a stable financial future, then you must follow some set of criteria, another pathway entirely. And what you save should be to the end that you invest it in something you understand that can help you multiply your funds. So investment is like a multiplier if you do it the right way. We all know that, okay, to make money these days, I'm talking about the traditional way of making money, where you get a job or you develop a skill and people give you projects, they give you contracts, you get it done, you get your money. But when it comes to investment, there are things you can just use your own money to just push the money out. And with time, the money itself will be making more money and you get better financially over time with that. But that must be done the right way. That must be done with sound understanding of what you are investing in. Because to lose money is easier than to make it. And a way to lose money is when you invest in something you don't understand. That's the fastest way of losing money. When you are investing in something you don't understand, that's the fastest way of losing money. So investing is simple, but it is not easy. It is simple, it is not easy. Why is it not easy? Because there are things that you need to understand. There are criteria, there are things you need to follow if you want to come out well with your investment. So the foundation of every great portfolio starts with asset allocation. Now, when we talk about asset allocation, as Momoriolu said the other time, when she was trying to describe our investment, like having a shares, bonds, and the like. So asset allocation is that what instruments can I invest in that will give me the highest possible return? There are different investment instruments out there. There are investments that it will take at least 7 years to multiply your money by 2. Like to double your money, it will take at least 7 years to double your investment. Those type of investments, they are low risk investments. I have a couple of them, like treasury bill, like government bonds, and some other type of investment like that. So treasury bill, the reason why it takes that longer period of time is because it is a very low risk investment. Your principal amount is secured. Like the money you are investing in it is safe. Nothing, there's little to nothing that can happen to that money, except if a serious global crisis happen, and which is unlikely to happen. You understand? So that kind of instrument is a kind of asset. Now, for you to know the type of assets you will allocate, you will choose. It depends on your investment goal. Okay, why are you investing? If you are the type that, okay, you want to build your wealth over time. So let's say you are thinking a very long time goal, let's say a goal of 10 to 15, 20 years. You should not be the type that is investing in a very high risk investment. Because high risk investment can bring you a quick return. At the same time, you can lose your money quickly. So if you have a long foresight, you are building something very great, you are going long term, you should focus on putting a large percentage of your money, the money that you have ready for investment, you should put them in a low risk investment. A large of them in a low risk investment like ETFs, like treasury bill, like government bonds, private equities, something like that. So you can put them in a low risk investment. Then probably let's say you put like 80% into a low risk investment, you can now share the rest in a medium risk and high risk investment. So medium risk investment, like probably you are looking at a local company shares, like Nigerian shares. So you share them into it and the like. And you do that on a regular basis. But if you are the type that your goal is just that, okay, you are looking for one quick cash to just probably meet some needs and the like, and you have enough appetite for undertaking risk. You know that, okay, this money you have with you, if you lose it, you're fine. At the same time, if you make money from it, a good one. So you can look at some instruments that are medium risk and high risk, depending on what your goal is. So everything is possible. And even at that, it's not that you will just because, okay, I have a goal that I just need this so amount of money in the next 3 weeks and the like, and you just dabble into one medium risk or high risk investment without understanding what you are doing. If you do that, you lose your money. And if losing is not a problem to you, nothing spoil, you're fine. But at the same time, you need to understand that instrument that you're investing in. So if it is a share, for example, you identify the company that you're investing in, you read about the company, you understand their cap, the cap volume of the company, you understand what they do, how they make their money, and the like. And you understand, okay, what is the trend of this company share over time? Trend that I'm talking about is that, okay, how do they behave weekly? How do they behave daily? There are some companies that in a day, they can drop in value by 5%, they can increase in value by 15%, something like that. And there's some company that in a whole 6 months, they don't drop, they don't increase, they are just stagnant. So probably they increase every 3 months or drop every 3 months or increase every 6 months or drop every 6 months. So these are the things that you need to understand about that company. Okay, how volatile? When you talk about volatility is that how can this company value increase or decrease? So how volatile is the company that I'm investing in? So, and if you have all these things in place, then you will know that, okay, this is the right thing that suits my appetite and my risk appetite, and you go for it. And whatever the outcome is, you embrace it. So the foundation of every great portfolio starts with asset allocation. And the core idea here is that you spread your money across broad, like as I've explained the other time, stock, bonds, depending. So, and the goal is that you want to protect your hard-earned capital against total losses. I said the other time that nobody wants to invest to lose. Everybody wants to invest so that you can make money from what you are investing in. You can make more money. And this is the reality. Over 90% of long-term returns are driven by this one simple decision. So, like, you don't want to lose your money. Nobody wants to lose what they hard-earned money that they have made over time. Now, where does the complexity of investment begin? Now, here we have expanding assets. If you want to have a kind of robust investment strategy that will prevent you from losing what you are investing. No, number one, it depends on the amount you have. You can't say you have 10,000 naira now and you want to spread your, you can't spread 10,000. What are you spreading? So you can't spread 10,000 naira. So it depends on the money you have at hand that you want to invest. You understand? It depends on your current capital that you want to invest. If you have huge money now, let's say probably you have like a million naira, so we can talk about spreading. Even if you have like 500,000, you can talk about spreading. You have like 200, 300, you can even talk about spending, but spreading rather. But you have 10,000 naira, what are you spreading? There's nothing you are spreading. You can just start somewhere, start with an instrument, ensure you understand that instrument, and as you are multiplying that money, then you can now begin to spread. You can begin to spread. Why do we spread? There's a saying that I know you might have heard before that, okay, don't put your head in one basket. The basket might be promising. The basket might have good track record. The basket might be a company that, okay, you have known that has been for years, that people are even giving reports, good news that this company is good, blah 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 blah. I saw one friend sister recently talking about MTN shares, that okay, MTN around December was around 400 and something naira, but now it's close to, it's like 700 naira, that it has shoots up and you can make money from it and the like. So some people can see such information and say, wow, MTN is doing well, and just put all your money in MTN. And you'll be shocked that that MTN that jumped from 400 last year, December, to about 700 naira now, you might jump into it now and it will nosedive, come down to 450 again. And just put your hand on your head and be like, wow, what has happened to me? So it is very essential that, okay, when you have funds like that, I'm talking of meaningful cash, that you spread such investments. So depending on the amount you have, you can spread and go into real estate a little bit, then take some commodities like you can purchase gold and some other commodities like oil and gas. Then you can go into um, shares and some other things and the like. And when we talk of assets, in finance, assets are things that, okay, they are bound to increase in value. So even you can even do a dollar investment. Dollar investment, it's just that, okay, dollar now is not as juicy as it used to be. It's just vacillating, going up and going down. So you can just spread that investment. And the reason why you are spreading is because, okay, if one of your investment instruments is not doing well, the other one will do well. It is unlikely that, for example, you have 10 different instruments that you have invested in. It's unlikely that the 10 at the same time are not doing well. If one is not doing well, the other will do well. Or it's also possible that everything might not do well at that point in time, depending on how strategic you are about the spreading. And that's what will lead us to that sector specialization. Now, let's say I want to spread an investment now. I have like 500,000 naira. I want to invest. I want to take, like for shares, for example, I want to go into shares. And I want to invest in 5 different companies. And I now choose like Dangote Food, Dangote Sugar, Boa Food. I also go to Cadbury. Then I pick, let's say I pick other 2 stock like that are into food and consumables. Now, if something happened in that sector that really, really affected the food industry, all my stocks will be affected. So that's not wise enough. Although to me, I'm thinking that I'm spreading, but I'm not spreading strategically. I'm not spreading to have a backbone, a strong backbone in case any shock suddenly happen in that sector. So if you want to spread, you go into different sector. For example, I can choose a share that is in finance, like banks or other stock that are finance based. I can go into agriculture, like Okomohoi, get their share. I can go into building and construction, like Dangote Cement, Boa Cement, or Julius Berger. I can also think of, okay, let me go into, just diversification of industries. So the reason why you do that is because if one industry is not doing well, another industry will do well. And there's nothing that can happen that will affect all of the industry at the same time. So it's wise to do that. And if you are blessed enough, you have enough capital, you can even go into international companies so that you can now dive into tech, into the tech work, like Nvidia, like Tesla, and the likes of them. Just that international shares are quite expensive. It's quite quite expensive, especially all those companies that are renowned. Okay, another thing here is that the complexity of premium. So does more complexity lead to better return? Often it leads to higher fee and decision paralysis. So now when you are, if you are not also careful about how you diversify it, some people might be saying that, okay, we need to diversify an investment and the like, and you now you have 100,000 naira, and you now spread that 100,000 naira on, you spread it like 10,000 naira into 10 different stocks. Even if you follow, like you follow different sector and the like, the wider you spread, the more charges you pay, the more tax you pay. Because when registering for the reports, for example, now you want to help a customer to register for a company share, you pay 500 naira for a company that you register if it's a local company. If it's an international company, you pay $1.50 as registration for that company. So if you choose to register for another company, you do the same thing. If it's a local company, you pay 500 naira again and the like. And when you are liquidating that stock or that share at the point of probably the time that you want to hold the shares is enough, and you feel that, okay, I'm good, I want to sell part of this share, or I want to come out of this share, there are fee that we still incur. What I want to bring out from there is that if you are holding on to 5 share, you will pay lesser fee than somebody that is holding on to 10 share. And you might be lucky if you are holding 10 share, all the 10 company shares you are holding can make good returns, and probably the fee you are paying might not be significant. But if you are unlucky that, okay, only 2 do well, 8 did not do well, it will have a great significance. So those are the things that might come up at some point. And this is the edge of simplicity. When you maintain a clear objective, it becomes harder as the number of available maintaining a clear objective become harder rather as the number of available products grows over the year. So maintaining a clear objective of your investment strategy. Okay, this is what I want to get out of this this company. This is what I want to get out of my money and the like. So every investment comes with a goal. A goal. Some people, they don't come to the investment with any goal. They just come because they want to make quick money and the like. So that's what they have in their mind, in their head, and they buy a company share today, and they just notice that, okay, the moment they purchase the company share, after some couple of hours, even let's say a day or two, the company share value drops, and they begin to shake, they begin to fidget, and because of that, they run out and say, "Oh, I want to sell my share," and the like. You doing that, you have you have lost already. That's a loss. That's a loss. So, but if you are the type that, okay, you come with a goal, a set of clear objectives. Okay, I'm holding this company share for the next 6 months. No matter what happens, I'm staying for the next 6 months. Now, staying for the next 6 months, you might purchase it today and it will drop the next week. But the next month, it can double in its increment and the like. And before the 6 months elapse, you might make good returns. So it's good to have a clear objective. And this section talks about expanding your horizon. This talks about when you have mastered the art of investment and you have more revenue, you have more cash, then it is good to expand your portfolio into a global, to have a global reach kind of. And having a global reach is that, okay, you are a Nigerian citizen, you base in Nigeria, you have Nigeria shares. Strategically, you choose, you select good companies. And also, you dive into international shares. I said the other time that they are quite expensive, but now you have the money. So you spread your tentacles to all those areas and the like, and you get their shares. You can get Tesla, you can even look at a company with low cap. I'm talking about the size strategy now. So combining large cap stability with the explosive growth for small cap. When I talk about large cap, there's some company that has large capital volume. Like they've made a lot. They used to make a lot of revenue yearly. They've been around for a while and they are renowned. They are well known. They have good legacy. Something like Tesla, something like Microsoft, something like Nvidia. So they are known, right? Those kind of company can give you a rest of mind that, okay, they have grown. Now they are mature. For them to go bankrupt is hard, something like that. So your money is quite stable with them. At the same time, they don't have, they might not have potential for growth like a company that is like a startup that is growing, that has a low cap. So a company that has a low cap at some point will grow to have a higher cap. Even all those companies I mentioned the other time, like Tesla, like Microsoft, once before they were also a local company, but they've grown. So you spread your investment across, looking at all those areas. And also the ending of complexity is that managing currency fluctuations and diverse regulation environments. So sometimes when you when you spread like that, it also comes with its own side, disadvantage kind of. So there might be currency fluctuations which might affect the market and some other things like that, and even regulations. Regulation like a country law can say, okay, they want to do something, ban export of this, ban export of that, and place a lot of restrictions which might even affect. But those are the downsides of it actually. So, and now, what are the complexity of investment? What are the illusions that comes with it? Quantity does not equal variety. Some people might be thinking that, okay, I have 800 unit shares of this company, then I'm fine. That does not equal variety. If you have 800 units of a company, it's still one company you have. It's not the same as having 500 units of company A, another 500 units of company B, and 400 units of company C. Somebody who have range of units across different companies have already diversified compared to somebody or another person who just own a single company. So owning Apple, Microsoft, and Google is not diversified. I think I've mentioned this the other time. So you are honing into a sector, though you have they have different name, Apple, Microsoft, but they all share similar characteristics. So they are still in the same sector. Anything that happen to Apple will happen to Microsoft, will happen to Google, because they are all in the tech realm. So anything that happens to one happens to the rest. Then also the industry sinkhole. So when the sector drops, every other stock drops. Every other stock in that diverse group goes down as well. So when we talk about the true diversification, it's about how different assets behave, not just how many of it you own. So you spread across different areas of investment. Then let's talk about the invisible thread correlation. So before I talk about that, can anyone hear me? Or I'm speaking to myself? All right, all right, all right. So we want to talk about the invisible thread correlation. Now, let's look at positive correlation. When assets move in lockstep, so your diverse portfolio fall at once. Let's say you own assets that are in the same sector. If something happens to, I think there was a time that, trying to remember the exact issue. There was a time that something happened in the stock market. That should be last year, I guess. That most of all the stock in the tech industry, all of them dropped. Nvidia, Tesla, all of them dropped at once because of just one single happenings. All of them dropped. And why did they drop? That thing affects those that sector because what happened is a major event that must affect any company in that sector. So that's a lock. That's talking about the lockstep effect that happened when something happened to an asset that is situated in a sector that something unpleasant is happening around the sector at that point in time. So it is best that okay, you have if you don't want to have that kind of correlation, like if you don't want that kind of happening to any type of investment that you are doing, it is best that you diversify across sector, not within sector. You diversify across sector. So you own a company in tech sector, you own another company in healthcare sector, you own another company in transportation sector, you own another one in agricultural sector, you own across different sectors so that if a major event happen and affect a sector,